Hi friends, very good morning all of you. So today we are going to look at one new problem in capital structure. This is comparatively a simple problem, but students are facing little bit difficulty because this was not there in the previous editions of ICA study material, but actually quite simple problem. So let us see, this problem is starting of net operating income approach. As you know, we have completely discussed net income approach, net operating income approach, traditional approach, Modigliani-Miller approach with tax, without tax, and also arbitrage. All these things we have covered completely in the classes. But the intention of making this video again is just to give you, the answer for the new problems introduced in ICI material. That's all. And this is not that, problem with so many complexities or intricate concepts. It is a basic problem. Okay. So shall we look at this? This is page number 12, illustration 5. Okay. Alpha Limited and Beta Limited are identical except for capital structure. What is the meaning of this? That means there are two companies probably operating in the same industry, having same size. So they are basically identical in all the aspects. That means their earning ability, their operations, all the things are same. But capital structure is different. How it is different? See, Alpha Limited has 50% debt and 50% equity, whereas Beta Limited has 20% debt and 80% equity. All these percentages are given in market value terms. Okay, now let us open one notes, and let us write some working note. Okay, particulars, Alpha Limited, Beta Limited. So equity, debt, total capital employed. So they are saying that equity, Alpha is having 50-50. Yeah? Yes, Alpha 50-50, Beta 20-80. Beta 20 is debt. So Beta has debt 20%. This is obviously 80%. So the total is 100, isn't it? And when it comes to Alpha, it is 50-50. This is 50%. This is another 50%. This is obviously 100%. Okay. So this is, the data given. Now try to understand without entering into the question. Let us try to understand some basics. Now you tell me, if you are equity shareholder, from the equity shareholders point of view, from the equity shareholders point of view, from the point of view of equity shareholder. Okay, holding equity shares of which company is risky? We are speaking about financial risk. So which company's financial risk from the point of view of equity shareholder is high? Obviously, this is high, this is low. Why? Simple. When debt is more, when your debt is more, your risk is more, isn't it? When the debt is more, your risk is more, because you need to pay interest, you need to pay fixed finance cost, which will increase the risk. Okay, so obviously return on equity required will be high here, will be low here, because the whole subject financial management, practically and theoretically both ways, will go with an underlying principle: risk and return travel in same direction, isn't it? Risk and return travel in same direction. So if my risk is high, my required rate of return is also high. If my risk is low, my required rate of return is also low. Okay, now let us go back to the question. The borrowing rate of both the companies is 8% in a no tax world. Okay, and capital markets are assumed to be perfect. These are nothing but the general assumptions of capital structure theories. Okay, don't worry about them. Under that A1, if you own 2% of the shares of Alpha Limited, okay, so we own 2% of shares of Alpha Limited. Okay, Determine your return if the company has net operating income of 3,60,000 rupees and the overall capitalization rate of the company is 18%. Very good. 2. Calculate the implied required rate of return of equity of Alpha Limited. Okay, very good. Return on equity, KE. Beta Limited has the same net operating income as Alpha Limited, obviously. Calculate the implied required rate of return of equity of Beta Limited. Very good. Now, you are calculating KE of Alpha Limited, you are calculating KE of Beta Limited. Now, obviously, they won't be same. Why they won't be same? Because there is a difference in capital structure. B2, analyze why does it differ from that of Alpha Limited. You understand? This is the question. Interesting, right? So half the students, after reading the question, they'll be scared. Sir, what is this question, sir? Don't worry, simple question. Okay, so shall we see? So first, let us take the data from the question. So 3,60,000 is the net operating income. Okay, so we are putting the heading. First, we are doing for Alpha Limited. Particulars rupees. So EBIT. They have given EBIT 3,60,000. Okay, what is EBIT? 3,60,000. And capitalization rate of the company, overall capitalization rate of the company, 18%. So KO given 18%. Do you remember in net income approach, KE, KD will be given, you need to calculate KO. In net operating income approach, KO will be given to you because it is a constant overall cost of capital policy. So net operating income approach is, irrelevance theory, capital structure irrelevance theory. That means KO will be fixed constant. So that is given 18%. So total value of the firm. How do you calculate total value of the firm? Value of the firm is equal to operating profit divided by overall capitalization rate. So it is 20 lakhs. So do you remember Alpha Limited's capital structure? 50% debt, 50% equity, right? Dekho, 50% debt, 50% equity. So if total market value of the firm is 20 lakhs, value of equity will be 10 lakhs. Value of debt will be 10 lakhs. That's all. Correct? Now, again, we'll take EBIT. What is EBIT? 3,60,000. Less interest. How much is interest? 10 lakhs is the debt into 8% is the rate given in the question. Correct? Interest rate is given as 8% if you observe. So 10 lakhs into 8% must be 80,000. So earnings to equity shareholders. How much? This minus this must be 260, 280. Sorry, 360 minus 80, 280. Correct. 280. So what they asked, look here, what they asked, calculate implied required rate of return. Implied required rate of return to equity shareholders is, see, how do you calculate rate of return to equity shareholder? Earnings to equity shareholder divided by value of equity, isn't it? So earnings to equity shareholder is 2,80,000 divided by value of equity is 10 lakhs, so 28%, isn't it? 28%. Correct. That's all. So A1 is over, A2 is over, but they said you have 2% of shares of Alpha Limited. So return to shareholder owning 2% in Alpha. Return to shareholder owning 2% of shares in Alpha. So total equity shareholders are getting 2,80,000. Total all equity shareholders put together are getting 2,80,000. In that 2,80,000, your share is 2%. So you will get 5,600 rupees. Wah, ware wah. Okay. So this is the situation. This is answer for A, Alpha Limited. Now come to Beta Limited. Beta Limited has the same net operating income as Alpha Limited. Very good. Calculate the implied required rate of return of equity of Beta Limited. Okay. Analyze why this is different. Okay. Now, look here. This is Alpha. Okay. Now let me put Beta Limited here. If you want, you can, prepare a new statement, same columns for Beta Limited, or you can prepare in columnar manner also. Okay, so if you look here, what will be the EBIT? Same. What is KO? Same. What is value of the firm? Same. But value of equity, value of debt will not be same, my dear friends. Here, equity 80%, debt is 20%. Oh. So, equity 80% into 80%, debt is into 20%, so debt 4 lakhs only. Now here you will take this 3,60,000 EBIT. Interest, how do we calculate? 4 lakhs into 8%, isn't it? So now your debt is only 4 lakhs. 4 lakh into 8% must be 4 8 32 32. Okay, so this minus this, 3,28,000 is earnings to equity shareholder. Now calculate the implied required rate of return to equity shareholders. Please be careful. 3,28,000 is the earnings to equity shareholders divided by value of equity 16 lakhs. Okay, so if you calculate, it is 20%. To be more precise, it will be 20.5%. 20.5%. Why is there a difference between these two? So, my dear friends, this is the answer for A. This is the answer for B1. And in B2, they are asking why? This is 28% and this is 20.5% only. Now, look here, analysis and conclusion. Equity shareholder of Alpha Limited has a required rate of return of 28%, and equity shareholder in Beta Limited has a required rate of return of 20.5%. This is because the financial risk assumed by equity shareholder of Beta is lower than that of equity shareholder of Alpha Limited. Why? This is because this is due to lower debt component in Beta Limited. If debt component is more, interest will be high. If interest is more, fixed finance cost is high. If fixed finance cost is high, financial risk is high. If financial risk of equity shareholder is high, he expects more return to compensate risk. That's what it is, ladies and gentlemen. This is one angle. This is practical angle. Theoretical angle is net operating income approach. If you go to the theory of net operating income approach, NOI approach, according to NOI approach, debt is a cheaper source of finance. Obviously, debt is a cheaper source of finance. However, the benefit of using low cost debt is compensated by increase in the expected rate of return of equity shareholder. Therefore, even by using low cost debt, KO doesn't come down. KO is constant. Instead, KE increases if debt usage increases. This is the theory. Okay, look at it. I am giving you both theoretical point of view and practical point of view. This is what exactly happens in stock market. This happens in your classroom. But of course, both of them are same. Okay, it is not that theory has no relevance in practice. This theory has high relevance in practice. That's all. So let us look at the answer of ICA. So did we get 5,600? Correct. Did we get all these numbers? Correct. Did we get implied required return on equity of first company 28? Yes. Second company 20.5%? Yes. And then the analysis. That is all, ladies and gentlemen. We have successfully completed this question. I hope you understand this.